Okay, for this video, I wanted to go over on a high level what the Section 663B election is for trusts and estates. So if you're looking at a Form 1041 filing, right, this is a federal income tax return for estates and for various types of trusts. There's a question posed in the other information section that asks you, is this an estate or a complex trust that is making this election during the year? So what is that election and how does it impact the trust tax return and the beneficiary's return for the year? Generally speaking, estates and complex trusts, and so complex trusts meaning the trustee doesn't have to distribute all the income during the year. So simple trusts, everything's got to be distributed out. Complex trusts, that's not the case. You can distribute either none, a little bit, or all of it. It really just depends on what the terms of the trust agreement are. So when you have an estate or a complex trust, all of the income, the expense, the distributions, it's all being recorded on a cash basis, right? That's generally how it works. So if a distribution is made during a certain tax year or fiscal year, it has to be recorded during that period. So it's going on that return. This is where the election comes in. So if you make a 663B election, it allows a trust or estate to make a distribution in a subsequent year and effectively roll it back to this period, right? So if you, it's a 65-day window. So 65 days from the start of a tax year, if you make a distribution, you can elect to have it recorded in the prior period. So why does this matter and how does it change things? Well, when property is being distributed out of a trust to a beneficiary, effectively what we're doing is we're shifting the income from the trust to the beneficiary. So generally speaking, the more income that is distributed, the more property that's distributed from the trust to the beneficiary, the more income that's being recorded on the beneficiary's tax return and not the trust tax return. Now this is also important because generally speaking, again, the trusts have higher effective tax rates than the beneficiaries most of the time. Not all the time, but in a lot of cases, that's the reality of the situation here. So there is almost an incentive to try to allocate as much income to beneficiaries as possible because overall it will create the lowest effective tax rate across all the parties. So before we get into the example here, some other considerations here. You know, we have to look at, well, what's the projected tax rate for the beneficiary next year? Because if we accelerate income this year to the beneficiary, would we have been better served by pushing it to the following tax year? Again, something to consider. Does the trust agreement even allow for this, right? Does the trustee have the ability to make additional distributions for this type of tax planning purpose? And then obviously, when we look at the example, what we're going to see is that we have to really know the tax profile of the trust that we're doing the taxes for and the beneficiaries, right? If we don't know the income tax profile of the beneficiaries, then we could be shifting income and just making it worse, okay? And again, it's not necessarily shifting, it's more accelerating income or the income inclusion for that matter, but we'll look at the example here and hopefully that'll make things a little clearer. Okay, so let's move on to the next slide here and see how this impacts the tax rates on the distribution. So here's our fact pattern, scenario one, then we'll look at two, where we make that election. So Jane here, she's a beneficiary of a non-grantor trust and is treated as a complex trust for federal tax purposes. Now, the adjusted income of the trust before any distributions is $20,000. Now, during the 2021 year, so this is within the calendar year, the trustee sent her a $2,000 distribution check. So the taxable income for the trust is going to be $17,900. And how we get that is the income before distributions, the distribution deduction, and then the $100 exemption that is afforded the trust. So based on this taxable income of 17.9, the total taxes owed for the trust are going to be $2,697. Now, the Schedule K1 that goes with the Form 1041, this $2,000 income distribution, the breakout based on this income within the trust is $49 of interest and $1,951 of qualified dividend income. So Now, if we look at Jane's tax return, her profile, if we assume that she's a single filing taxpayer, she makes $75K a year, and she's going to use the standard deduction, so she's not itemizing. When Jane includes the income on her return, assuming this is what was set in stone, the amount of extra tax she's going to owe on the investment income is the $293. So if we look at the trust return and Jane's return, the total amount of tax that's being paid on this investment income across both parties is collectively $2,990, right? That's for the 2021 tax year. So now let's look at how we modify the fact pattern a bit if we have distributions in 2022 and make an election to record them in 2021. So same fact pattern as far as the numbers go about income, right? So the trustee distributes $2,000, and then because they looked at this profile, what the taxes would look like, they decided, well, what if we distribute $6K to Jane in 2022, January, so 1 month after the close of the tax year, and we make this 663B election to roll back that distribution to 2021. How does that change things? So now the total distributions reported for the year are going to be $8,000, right? The $2,000 plus the $6,000, and the total income before distributions is remember, it's still $20,000. We haven't had any additional income or anything like that. So now, because of the increased distribution deduction, the taxable income of the trust is $11,900 with a tax liability of $1,380. So remember, generally speaking, the more money that is distributed to a beneficiary during the year, the more income is being allocated to them on their K-1 rather than being taxed within the trust. Okay, that's generally how these complex trusts work. So the K-1 now for Jane shows $8,000 of income distribution, which includes $195 of interest, $7,805 of qualified dividends. And so now when Jane files her same tax return, the amount of incremental taxes she's going to owe on this $8,000 is $1,204. Okay, so makes sense, right? The amount of tax she owes goes up a bit because she's recording more income on her return. Now, after doing that, what does the collective tax footprint look like? So now the total taxes owed on the trust income under this scenario is $2,584. Right, so the 2,584, that's the 1,204 in taxes that Jane owes on her return, right? And then the taxes of 1,380 is what the trust owes. So if you add these two together, the total taxes owed on the trust income is $2,584. Now, when we compare that 2,584 versus the first number, 2,990, we can see that collectively the balance is lower, right? So the tax savings for the year are now $406, right? $2,990 over the $2,584. So very simple example here, just illustrating how you can save taxes in the current period by rolling back these distributions. This doesn't always work though, right? You have to be very careful with planning the rollback and what certain amount you want. And then again, as I noted on the first slide, there's other things to consider. Like what if Jane's effective tax rate was significantly different in 2022? Now obviously we don't know that because it's still early in the tax year, so we have to project it. But let's say for argument's sake that Jane lost her job in 2022 and couldn't find work again. Well, in 2022 then, that means her overall effective rate would be lower, right? And so maybe it would have made sense to record that $6,000 distribution in 2022 rather than make it apply to 2021. So, again, this is not always a kind of slam dunk decision to make. Very careful consideration has to be done for the tax profile of the trust, the beneficiary in the current year, and what you project the subsequent year will look like as well. So, so that covers it for this little tutorial on it. So the 663B election, always something to kind of keep in mind when you're advising your clients on the trust distributions, or if you are a trustee, right? If you're a trustee, you should be mindful of these rules too, because It could be something that you're doing on behalf of the beneficiaries to make sure that you're helping them, overall, again, lower their overall tax footprint, tax profile, that is. Okay? All right, so again, that covers it. Thanks for watching. I hope that was helpful. If you have any questions on the elections, feel free to leave me a comment below. Happy to answer it, and I can, and I look forward to seeing you again on the next video. Thanks and take care.